everyone, welcome back to X and Young channel. In this video, let's talk about one of the ways to diversify into property investment, the real estate investment trust. And let's talk about the frequently asked questions around this topic. What are REITs? Are REITs riskier than stocks? What is the difference between investing in REITs versus buying a property? What are the risks of investing in REITs? And how to pick REITs. So I will be using Singapore REITs to compare, so stay tuned to the end of the video. First question, what are REITs? Real estate investment trusts or REITs are like investment vehicles that pool funds from multiple investors to invest in real estate assets or properties. And you as one of the investors is entitled to a slice of the real estate pie without having to own or manage the properties yourself. REITs is run by the company that owns and operates income-producing real estate or properties. They are traded on stock exchange just like the stock. To invest in REITs, you will typically need a brokerage account. That's it. Second question, are REITs riskier than stocks? While both REITs and stock have their own unique risk factors, REITs are generally considered to be less risky compared to individual stocks, but they are not without risk. REITs are backed by tangible hard assets, which are the properties. That's why it can offer more stability to your investment portfolio. The key difference between REITs and stock is the distribution ratio. Compared to some stocks that are not paying any dividend, while some are paying depending on the company performance, REITs by law are required to distribute at least 90% of their profits to shareholders in the form of dividends. This makes them a good source of passive dividend income. REITs and stock are associated with different types of industry risks. As you can see, REITs are specifically linked to property market, while stock depending on the stock industry that you buy. Third question, what is the difference between investing in REITs versus buying a physical properties? There are a few key differences. First, the barrier to entry in REITs is lower. In Singapore property context, in order to buy a property, you are required to put down certain percentage of the property value as down payment. And this can be a huge sum of amount, as Singapore is well known for its expensive properties. However, if you're investing a portion of real estate, the minimum units are 100 and it could be as low as just few $100s to start getting the property exposure in Singapore. Second, liquidity. REITs are more liquid than property, as REITs are traded on the stock exchange. That means you can easily buy and sell on the stock exchange compared to buying a physical properties that could take months. And in terms of selling, you can easily liquidate your shares of REITs during any active trading day via a brokerage account. While compared to selling a physical properties, the procedure is more complex, as you will need to engage with agents and lawyers, and it could take months and up to a year to sell a property. Third, diversification. REITs are more diversified than owning a property. This means that your investment is not exposed to the risk of owning one single property. A REIT can consist of multiple properties in different countries, not only in Singapore, but it could be investing in Malaysia, Thailand, Vietnam, or Indonesia. So we can say the concentration risk is lower compared to buying one property in Singapore. Fourth question, what are the risks of investing in REITs? Like any investment, REITs come with risks, include the real estate property market risk, so the value can go down when the overall property market declines. And it is very sensitive to interest rate. When the interest rate increase, so as the borrowing cost, this can reduce the profit and also the dividend payout. Leverage risk means the REITs company can use leverage or debts to magnify their returns, and this result in higher risk of the company. If the value of the assets decline, they may not be able to pay their debts. Management risk, meaning the successful of the REITs depends on the quality of the management team. So if the management team makes any poor decision, the value of the REITs assets could decline too. Fifth question, how to pick good REITs. So many people are buying REITs for dividend income. However, it is important to look at the overall gain, which include the capital appreciation or depreciation. Generally, REITs in Singapore are giving out pretty decent dividend ranging from 4 to 7% per annum, but it is noticeable that some REITs value are dropping, which should be also taken into account. Some of the ways to compare REITs is by looking at their growth prospect, their financial performance, and valuation. For growth prospect, distribution per unit, which is the amount of dividend to each investor for each share they own. This is equivalent to the earning per share of the stocks. If the distribution per unit is increasing year over year, it means the company is growing, and that's why the dividend payout yield will be higher. For financial performance, as per usual, we could check out the company profitability. Lastly, before buying any REITs, it is important to look at the valuation by checking the company net asset value. If the REITs to compare by checking the company net asset value divided by the total outstanding shares, so that we can see if the REIT share is currently over or undervalued at the point of time. Let's take a look at Capital Land Integrated Commercial Trust, which with the annualized dividend yield of 5.6%. From its website, we can quickly see their net property income in the first half of 2023 has increased to $552 million compared to the same period last year. The net income was $501 million. While their distribution per unit has also increased slightly from 5.22 cents to 5.3 cents. This means that the company is growing, and definitely a positive sign. Then we can quickly look at Fraser Logistics and Commercial Trust with higher trailing 12 months dividend yield at 6.23%, but their distribution per unit has declined compared to the same period in previous year from 3.85 cents to 3.52 cents. So there are pros and cons of each REIT in this case. Fraser Logistics and Commercial Trust offer higher dividend yield but with declining distribution per unit, which can be a red flag that the company is not performing well. It can be further investigated. Since those are publicly listed companies, the information are readily available for investors, and the reason for reducing distribution per unit in the case of Fraser LNC Trust is due to the lower net property income that has dropped by 14% year over year. However, purely for quick comparison, and it is very important to remember that this past performance is not a guarantee of future result. Hope you found this video helpful. Give us a like, share and subscribe to our channels. Thank you for watching, and see you again in the next one.